All right, warm welcome everybody to a brand new week. I hope everybody had a good weekend and is ready to kickstart the new week. Now, very interesting moves across the board last week. Remember, 2 weeks ago, a week and a half ago, we had the US jobs data. And for those of you who watched the week ahead video last week, you would have known that the jobs data came in pretty much in line with expectations, but we had very, very big revisions in that data, which saw the markets react very ugly to that data. You know, on the back of that data, we saw the dollar pushing lower, which is this big move lower here. We saw equity markets pushing lower and stressing on the back of that move as well. We had yields pushing down with obviously treasuries pushing up. It was a real big reaction. Now, even though the US dollar continued to trend lower throughout the majority of last week in line with expectations after those revisions, we didn't really see the same ugly fate playing out for the likes of equity markets. I mean, if you take a look at equities, yes, we had a big move to the downside. We reached those key levels of support that we looked at towards the start of last week. And equities have just managed to recover almost the entire drop. If you take a look at something like the NASDAQ, we are almost right back up to prior all-time highs, which was just a beautiful recovery from equity markets. Equities obviously choosing to rather focus on the positive earnings that we've had so far this quarter, and obviously the prospects of rate cuts, more rate cuts from the Fed has been enough to see equities lift up. I mean, if you take a look at some of those big seven, those max 7 names, we ended the week so strong. Apple was up over 13%, Google up 6%, Tesla was up close to 9%, and Nvidia up to 5%. The likes of Amazon, which struggled the week before, was actually up close to 4% as well. So it's been a real decent recovery when it comes to equity markets. But of course, the same fate wasn't true for the US dollar. That continued to drift lower for the majority of the week, in line with expectations on the back of those very big and nasty revisions that we had. So very interesting moves that we had. The other one that we just need to be aware of is the big moves that we had in gold futures markets, not gold spot prices. What do I mean? If I quickly pull up this chart for us, what we have on this is we have the regular spot price for gold, which is trading or did trade close to 3,400 going into the back of Friday. And that's the red and green candles that we can see here. But then you can see this huge rush that we had to the upside in COMEX futures. Now, why did this happen? That happened on the back of the unexpected tariffs on 1 kilogram gold bars that was set by the Trump administration. Pretty confusing as to why that was put on in the first place. The markets are still dealing with the why. There's many different reasons for what it could be. Some are saying that it's purely there to hit Switzerland, which has obviously been hit with massive tariffs. Look, whatever the main reason is, the markets aren't sure, but the bottom line is there was a big disparity, a big divergence between spot prices and COMEX futures. Now, why this is important, because even though, if you're trading spot and you look at that move, you're like, okay, that doesn't concern me. I don't have to worry about that. But if you are trading gold, whether you're trading that as a swing trader or as a day trader, this should absolutely matter to you, because what these types of gyrations have done, when you have these big dislocations between futures pricing and spot pricing, it messes with the way the markets price risk. It messes with the way that the markets look at premiums. And one of the big negative impacts that this has had, and I'm sure some of you would have seen this, is in the way that spreads behave around the gold market right now. Whether you're trading spot or not, spot prices or spot spreads have been negatively impacted as liquidity providers have basically been dealing with this dislocation between various prices. And so it's going to impact you as a day trader trading gold, and it's also going to impact you as a swing trader, because this will most likely impact swap prices in the markets as well. So even though it didn't impact the overall price, and even though gold spot was fairly muted last week, the big pop we had to the upside in futures pricing, and obviously the negative impact that has had on spreads and swaps, definitely something just worth keeping in mind as we go into the new week as well. So with that quick rundown of where we are standing across major asset classes, let's just quickly take a look at the week ahead. Now, in terms of the week ahead, There's only really one major event to get excited about this week, and that is, of course, the July US CPI data that is due on Tuesday. However, we do get a few other risk events throughout the week. We have UK jobs as well as GDP data, which could be interesting, especially after last week's BOE decision. We'll touch on that in a second. And then we also have the RBA decision coming up on Tuesday as well. But I doubt whether that is going to be very exciting. Unless the RBA pulls another stunt like they did last month by holding rates steady again. I doubt that happens this time around, but we will touch on that in a second as well. So let's quickly take a look at the main event, which will be Tuesday's US CPI. Now, this print is going to be interesting because we'll find out if June's first signs of tariff pass-through was just a blip, or whether it is a start of a stickier trend in core goods inflation. Remember, core goods inflation was up 0.7% last month, which was massive. Consensus right now is expecting headline inflation to drift lower from the prior, from 0.3 to 0.2, but for the year-over-year headline to tick up from 2.7 to 2.8. And in terms of core numbers, which will be the main focus point, that is expected to tick up for both the month-over-month as well as the year-over-year, with core year-over-year expected to reach 3%, which is a pretty scary number for the Fed to be dealing with. In terms of the logic here, for headline, the reason why headline is expected to drift lower is basically going to come down to cheaper gasoline and calmer food prices. That is expected to keep the headline contained. But core goods, obviously where tariffs are biting, as well as shelter prices, is expected to see core inflation nudge up. Now, again, even though all of the data matters, the one thing that really matters this week for US CPI is what those core goods numbers will be looking like, right? We already saw evidence of tariff pass-through in the June data, and desks across the board think that the same theme will just repeat in July and potentially with the August data as well, as different firms will most likely start passing on those import costs. Autos could be a little bit of a wild card after some dealer auction dynamics hinted at possible upside risks as well. So that's something that I did note in a couple of previews. The other one that is going to be interesting will be shelter pricing. I mean, shelter prices are still running above trend, and it's basically kept services sticky for a little bit longer than previously thought. And if you put that together with higher possible core goods prices, then things can get really, really messy for the Fed this week if data comes in super hot. Now, what would constitute a very hot print, and how will the markets likely react? Now, in terms of a hot number, we can see the market's maximum expectation for the core number is 0.4 on the month-over-month and 3.2 on the year-over-year. Now, I think if we get anything close to that, 0.4, 3.2 or higher, that's going to be very problematic. And your first initial reaction that you would expect to see on a very hot print in core inflation this week is you would expect the dollar to pop higher. You would expect things like, so you would expect the dollar higher, you would expect yields to move up, you would expect things like equities as well as gold to push lower, because it'll basically push back against rate cut bets a little bit. Remember, if you take a look at rate expectations right now, after that prior NFP report that we had, the markets are currently pricing in close to 60 basis points. So that's two fully priced cuts for this year, one almost fully priced for September, and the other one fully priced by December. So if we were to get really hot inflation data this week, then that could start to see the markets potentially pushing back a little bit against those expectations. If you consider things like positioning data, for example, even though the dollar has moved out of very stretched short territory, remember that is most likely before the recent moves we've had to the downside. It's very likely that positioning after this move lower in the dollar is once again sitting in stretched short territory. So that will suggest, if we were to see really hot numbers that pushes back against the cut expectations, then that could see a little bit of a pop to the upside in the US dollar. It most likely sees a bit of a drag on equities and a drag on gold. However, and this is really where the kicker comes in, this is probably not the type of trade that I would be looking to hang on to for a very long time. It'll most likely only be a short-term play. The reason for that is because think about it this way. The jobs data remains a big concern for the markets, right? Will markets just ignore the big jobs revisions that we had if we get a hot CPI print this week? Probably not, right? So that means a beat, even though it will be very attractive as a short-term play based on things like how the dollar is positioned and how equities are positioned, that will most likely be not something I want to be holding on for a very long time. It'll be something that I would be looking to get out very quickly, because any type of equity downside or dollar upside could be short-lived if the markets choose to be a little bit more cautious with how aggressive they price out those cuts. Because remember, apart from this CPI print this week, we have another jobs number and another CPI print all before the September meeting. So a lot can still change, but I'm not expecting the markets to fully price out a September or the December cut just if we get a hot CPI number, because they will want to see what happens to the jobs data first. So I'm not saying that a hot CPI can't push the dollar up or equities down. That would be my first assumption of how the markets react, and that could really be tradable as a short-term trade. But I would be most likely looking to trade that very short-term for the risk that the markets might look through that hot CPI and say, okay, well, let's just wait and see what happens to the jobs data. Because if the jobs data, the next one, is very ugly and we don't get any meaningful upward revisions to those downward revisions, then the markets will most likely stick to a cut. Because yes, it's very tough on the Fed right now to cut rates when inflation is high. But if the labor market is really struggling, that's the other part of their mandate. They've got a dual mandate, remember. They have to keep prices stable, but they also have to ensure maximum employment. They can't allow the labor market to massively weaken just because of tariffs, right? They would need to step in and do something. So I think a best short-term play would be very hot data, looking for a bit of a lift in the dollar, looking for a bit of a drag on equities, but those will be short-term plays. And that also means, from a purely sentiment point of view, the simplest trade for the week ahead would be one where we see US CPI surprise massively to the downside when everybody is expecting the opposite, right? If we were to see both core and headline pushing lower, potentially sticking close to the prior numbers or lower than that even, I think that would be the most cleanest trade that we can hope for in the week ahead. Because imagine if instead of seeing upside in core CPI, imagine we actually see a downside surprise when everybody is expecting an upside surprise. That would mean that the expected pass-through of tariffs has not been as big as many or most have thought. And more importantly, if inflation is not standing in the Fed's way after that NFP revisions that we had, I would not be surprised if the markets start pricing in a very decent probability of even a 50 basis point cut for September. I know that sounds crazy right now, but think about it this way. The only thing that the Fed said is keeping them away from cutting rates right now is uncertainty about how much tariffs will push inflation up. They assume, as is the case with the majority of analysts out there, that we will see further pass-through of tariffs into inflation. If that proves to be false, then there's no reason for the Fed not to cut rates more aggressively. If the data shows us the initial concerns for inflation was overstated, then the bad jobs revisions will be seen as even worse by the markets, because the Fed will then be seen as being behind the curve. So again, a short-term big upside surprise like 0.5 or 3.3 or anything close to the max there could be interesting to see a bit of a lift in the dollar, a bit of a drag in equities. Those will be very keen short-term plays that I will be looking at for Tuesday. But the simpler trades could be further dollar downside or further equity upside if we have inflation actually surprising lower when everybody's expecting it to surprise higher. I think that'll be by far the most sexy surprise we can look for or hope for in the week ahead, in terms of having simple trades to aim for. Now, we also have other US data in the week. We've got a couple of Fed speakers, which will be very important, especially after US CPI, to see how the CPI data might be impacting their decision about rates going forward. But we also have things like the retail sales data coming up on Friday. We've got another batch of job numbers, jobless claims. We've got another batch of PPI data, but all of these won't be as important as CPI, and they will only be important if they surprise in the same direction as CPI does. For example, if CPI comes in really hot, you probably want to see those other data points like retail sales and prices paid or PPI printing very solid as well, to see further upside in the dollar, downside in equities, or alternatively, if CPI comes in really low, you want to see those other things surprising lower as well, just to add to the conviction of those trades. So just keep that in mind. Definitely the main event, and two very clearly tradable opportunities, both for an upside as well as a downside surprise in my opinion. Now, what about the other data we get? For the UK, we get jobs data on Tuesday, and we also get GDP data coming up on Thursday. Now, this will be, I'm not expecting massive fireworks from this, but it will be interesting after last week's Bank of England decision. After the decision, I'm hoping that both GDP and jobs data comes in much better than expected. Why am I hoping that? Well, I'm hoping that selfishly, of course, because I got into a short position on euro sterling on the back of the Bank of England decision. The reason for me getting into that trade is because the Bank of England took a more hawkish tilt than what the markets anticipated, right? We had a vote split of 5-4 voting for a cut. Now, that was important because the markets were expecting a vote of 7-2, meaning the markets was thinking 7 of the 9 members would be voting for a cut, while 2 voted for a hold. But instead, we had only 5 of them voting for a cut, and 4 of them showing more reluctance voting for a hold. Now, that is very important because we saw also upgrades to the both growth and inflation forecasts. The inflation one wasn't a surprise. The upgrade to growth, however, that was quite a surprise, especially after the recent data that we've had. So for me, there was just very little reason to expect the euro sterling pair to push up. There's very little reason for it to do so on the back of that Bank of England decision. And if you take a look, if I just quickly bring up the differentials here. Now, this is looking at various different market measures versus euro sterling. You've got euro sterling in black, and you've got various other market measures looking at risk reversals, yield differentials, growth differentials, inflation differentials, commodities terms of trade. All of these things show us possible downside risk here for the pair as well. So happy to hold on to that. And obviously, selfishly, on the back of that, I'm hoping that we see a big upside surprise for the jobs data and an upside surprise for GDP. If we don't and we see really, really ugly data, I'll probably be looking to get out at break even on those remaining positions for euro sterling. So that is also something worth watching. And then the other one that I'm the least excited about this week will be the RBA policy decision. We can see here from rates markets that a cut this week is fully priced at 25 basis points. Now, the only way that the RBA will be able to surprise us this week is if they decide not to cut rates again. Remember, we had that very shambolic decision from them a month ago where they didn't cut rates when almost everybody was expecting them to cut rates. The reason why everybody was expecting them to cut rates is because they tilted very dovish 2 meetings ago. Surprisingly dovish. They cut rates. They even opened the door to potentially cutting rates 50 basis points at a time. They told us that their previous concerns about inflation didn't materialize. The bank was very dovish. And then a month later, that was last month, it seems like everything changed for them, right? All of a sudden, they are concerned about inflation again. They're very focused on quarterly CPI data. and they decided to not cut rates when everybody was expecting them to. Now, nobody's expecting them to make the same mistake because they had real egg on their faces last time around. It's not, uncommon for the RBA to have egg on their faces, let me tell you. I'm not going to go into a full rant about how bad this bank has been in terms of their communication with the markets, but last month was a very good example of what we were used to a couple of years ago with the previous Governor Lowe. But anyway, markets are expecting a cut. So if we do get that cut, that shouldn't really impact the Aussie dollar in any way. What will be a focus point, though, is the tone and the language. Nobody is expecting the bank to suddenly open up the door to more cuts because they're going to get more egg on their faces again, right? They can't chop and change drastically every meeting. So the markets are expecting a cut, but also expecting them to maintain that very gradual approach towards easing. Very similar to what we have with the Bank of England right now, where the markets are assuming, give or take, one cut per quarter. That is the broad expectation in terms of what we'll get from language from the RBA. Now, what is interesting here, if you take a quick look at positioning information, you'll see that the Aussie dollar is by far the biggest net short position still among the major currencies. You can see here that we're trading, in terms of the data that I have here, it's the lowest or biggest net short position in the Aussie dollar going back over the last 15 years, right? That's a big deal. What does that mean? It simply means that the best case scenario for those of you wanting to trade the Aussie dollar would be if the RBA comes out a lot more hawkish than what the markets are anticipating. How could they do that? Obviously, they could decide to hold rates steady again. I don't think that happens, but obviously if rates is held steady, the Aussie dollar could pop big time in the short term. Alternatively, though, if they do cut rates, but they push back against the idea of the markets pricing in further cuts for the rest of this year, that could be good for the Aussie dollar as well. Because keep in mind, if you take a look at that December meeting, the markets in total by year end is still pricing in about 60 basis points. That's 2 fully priced cuts. So if they cut now this week, the markets are already pricing in, or have already fully priced in, an additional cut by November. If they push back strongly against that additional cut that is currently sitting at about a 65% probability for November, that can obviously see a lift in the Aussie dollar, and that would probably be the most attractive opportunity to trade in the week ahead, potentially against the dollar, assuming US CPI comes in low, right? So if we have the RBA coming in hawkish, a lift in the Aussie dollar, but then you have to obviously navigate the US CPI data, which could be a bit of a risk. So Aussie dollar upside could be good if we have hawkish RBA as well as a miss in US CPI. If you want to avoid the risk of US CPI, Aussie Kiwi is normally a good play as well. We're sitting very close to recent resistance. Retail is still very short this market, which means there is a higher probability of some upside risk as retail, normally does. That is normally on the wrong side of these trends, as we know. So if we do press into these key levels of resistance on a hawkish RBA, if we pop above that, we could be, navigating back up towards these recent highs from April as well as March, around that 110 psychological. So just keep that in mind as a possible risk. But again, the RBA definitely my least favorite thing, or the thing I'm least excited about from a risk point of view for the week ahead. So that's just a quick look at what we have coming up for the week. I hope you guys have a fantastic one. And as always, any questions, don't hesitate to let me know.